Which statement below is an example of how ratios are used in the field of finance? A firm's ratios are compared with those of a benchmark peer group to determine the firm's relative strength and performance. Why are ratios considered flexible? Because they are not regulated and can be changed or invented according to a firm's needs. How might calculating financial ratios help shareholders? Ratios can be used to determine whether a firm is maximizing shareholder wealth. The firm Betsy's Books conducts a financial analysis using ratios to know how it is performing in comparison to other similar firms. What is this process called? Benchmarking allows management to see how firms differ from one another and evaluate their performance relative to each other. Why are ratios used in financial analysis? Compare companies with different sizes, varying strategies, and different amounts of risk. What makes ratios flexible in financial analysis? New ratios can be created to meet specific analytical needs. How do ratios assist in evaluating a firm's performance? By indicating what aspects to focus on for a detailed analysis. In what way do ratios become meaningful in financial analysis? Through comparisons such as trend analysis, cross-sectional analysis, and progress measurement. What type of ratio is used to assess a firm's ability to meet short-term obligations without raising external capital? Liquidity ratios measure a firm's ability to meet short-term obligations without raising external capital. Why are several different types of ratios used to analyze a firm? Because different types of ratios are needed to get information about different parts of a firm. Using only one type of ratio in a full financial analysis of a firm would not tell you very much information about the firm. It is through the calculation of many ratios that an analyst will be able to see the bigger picture of the firm. What do leverage ratios describe? What proportions of equity and debt a firm uses to finance its assets if a firm has paid off its short-term loans more quickly in the past couple of years? What might this trend indicate about the firm's financial ratios? Its liquidity ratio is increasing. Liquidity is a measure of the ability of a firm to convert short-term assets into cash. Paying off short-term loans quickly is an indication that a firm is quite liquid, so the firm's liquidity ratio would be increasing. What do liquidity ratios primarily measure? A firm's ability to meet its short-term obligations. What is the primary purpose of activity ratios in financial analysis? To measure how well a company uses its assets to generate sales or cash. Leverage ratios are used to assess how a firm is financed and its financial risk. What is the main focus of profitability ratios in financial analysis? Judging how well management is maximizing shareholder wealth. Market ratios are primarily used for evaluating the current share prices of a public firm's stock. Which type of ratio is a current ratio? Liquidity. A current ratio is a liquidity ratio because it assesses whether a firm can meet short-term obligations. What is the main difference between the current ratio and the quick ratio? The current ratio includes inventory and current assets, and the quick ratio does not. Inventory is the least liquid of all current assets. By not including inventory, the quick ratio is a more stringent test of a firm's ability to meet short-term obligations. The firm Betsy's Books has a market-to-book ratio of 1.2. What does this tell you about the firm? This firm is expected to grow in the future. The market-to-book ratio measures the growth prospects of a company. If the ratio is greater than 1, then the company is expected to grow. What does the net margin measure? The percent of revenue that is retained as profit for the firm. The net margin is net income divided by sales, which tells us how much a firm actually gets to keep after paying all its expenses. How do the current and quick ratios primarily differ? Current ratio includes inventory, while quick ratio does not. What is the main purpose of activity ratios, like inventory turnover and accounts receivable turnover? To check short-term operating asset management efficiency. The debt ratio is an important measure because it indicates the capital structure of a firm. The times interest earned, TIE, ratio is crucial for understanding a firm's ability to pay interest and meet long-term obligations. Profitability ratios are used to understand a company's performance and cost efficiency, which ratios are primarily used to assess whether a stock or a firm is correctly valued. Market to book, M/B, and price to earnings, P/E. Which of these measures is a component of return on equity? Net margin, total asset turnover, and leverage multiplier are the components of return on equity. How can the DuPont framework help a company assess its return on equity? It allows the company to determine how its abilities to generate profits, manage assets, and use financing contribute to the return on equity. The DuPont framework breaks the return on equity into each of these components using the profit margin, total asset turnover, and leverage ratio, which action increases the return on equity of a firm if all else remains constant. Increasing debt financing increases the leverage multiplier, which means that the ROE increases. What is a component of the DuPont framework? Return on assets. ROE is ROA times leverage multiplier. What is the primary purpose of the DuPont framework in financial analysis? To analyze where changes in return on equity, ROE, come from. Return on equity, ROE, is a composition of which aspects of a firm? Profitability, efficiency, and capital structure. What is one way that a firm can improve its return on equity? Successfully cutting production costs to boost net margin. Increasing net margin increases the ROE. Big Dog and Small Dog are two companies that have an identical return on equity. One difference between the two companies is that Big Dog has 40% of assets financed by debt, while Small Dog has 100% of assets financed by equity. What can you conclude about Big Dog and Small Dog? Small Dog has a higher ROA than Big Dog. Since Small Dog has no debt, the leverage multiplier of Small Dog is smaller than that of Big Dog. Since both companies have the same ROE, Small Dog must have a higher ROA, which actions, taken together, will certainly increase a firm's ROE. Increasing net margin and decreasing debt financing. Increasing equity financing increases the leverage multiplier, therefore increasing ROE, and increasing net margin also increases ROE. Why is it important to analyze the return on equity, ROE, using the DuPont framework? Because it reveals how identical ROE figures can be composed differently across firms. What does the DuPont framework help reveal about a firm's return on equity, ROE? The components driving the ROE, such as profitability, activity, and financing components. Why are ratios considered useful in financial analysis? They standardize data to make companies comparable and help focus on key analytical questions. Ratios can be used to compare a company against its past performance, competitors, and its own set goals. How many major categories of ratios are there, and what are they? 5. Liquidity, activity, leverage, profitability, and market. What does the DuPont framework decompose the return on equity, ROE, into? Net margin, total asset turnover, and leverage multiplier. A company currently has a ratio of 1.5 but hopes to improve the ratio to 2 to align more with the industry benchmark. To achieve this goal, costs were cut in production through an investment in efficient equipment, and the company achieved a higher profit margin. If this continues, you are certain that the firm will achieve its goal in 2 years. What is this an example of? Progress measurement. You are comparing the company's ratio to the goal and checking how the company is progressing toward the goal. Flexibility. For what purpose are market ratios used? To evaluate the current share price of a public firm's stock. Market ratios are used to evaluate whether the current share of a public firm's stock is correctly priced. You are considering starting a new business to sell widgets in your hometown. You can import the widgets at a low cost, and you hope to be able to sell them for significantly more. Which ratio can help you calculate how much profit you will earn from the sale of each widget? Assume you are only considering the cost of the widget, not any other operating costs. Gross margin tells you the percent of sales that become gross profit. The rest of the money earned from sales is used for the production of goods. What allows an investor to determine which financial activities are contributing to changes in the return on equity? DuPont Framework. Decomposing the DuPont Framework enables analysis of fundamental performance to determine which financial activities are contributing to changes in the return on equity. Knowing that you are taking this finance class, a friend asks you about 2 investment opportunities he is considering. He wants to know which of the firms is using its assets more efficiently to generate sales. Which set of information could help you determine this? Firm A has an asset turnover of 4, and Firm B has an asset turnover of 2.5. Asset turnover is an indicator of how well a firm uses its assets to generate sales. Since Firm A generates $4 of sales for every $1 of assets, it is using its assets more efficiently. Which method of ratio analysis looks at a firm's performance over time? Trend analysis looks at a firm's financial ratios over time. You are a financial analyst of an investment bank, and you are doing research on equity. You are looking at a book publisher's financial ratios in comparison to its competitors and the industry average. What is this an example of? Cross-sectional analysis compares a firm's financial ratios with those of a peer group. Which type of ratio are suppliers interested in? Liquidity ratios assess a firm's ability to meet short-term obligations to short-term creditors and suppliers. What is the ratio that tells you on average how long it takes for a firm to collect accounts receivable? Average collection period. The ACP tells how long on average it takes for a company to collect accounts receivable from its customers. What does a debt ratio of 40% indicate? It indicates that 40% of assets are financed by debt. A debt ratio tells the portion of assets financed by debt. What is operating margin useful for? Comparing the profitability of firms with different capital structures. Operating margin is calculated pre-interest, so you can frequently use it to compare firms with different capital structures. What does an average collection period of 70 tell you? On average, a firm takes 70 days to collect accounts receivable. This ratio tells on average how many days it takes for a firm to collect cash from accounts receivable. What does high inventory turnover relative to the industry and competitors indicate? The firm does not hold enough inventory and is making its customers wait longer to receive their purchased goods. A high inventory turnover ratio indicates that there is not enough inventory available to meet customer needs in a timely manner. What is the difference between return on assets, ROA, and return on equity, ROE? ROE considers the capital structure of a company, while ROA does not. DuPont Framework tells you that ROE is ROA times leverage multiplier. The leverage multiplier represents the capital structure of the company. Minico recently spun off of BigCo. Both companies have the same leverage and asset turnover ratios, but Minico is underperforming on its return on equity to shareholders. If Minico would like to improve its return on equity, which action would help? Reduce costs to improve its overall profitability. The third component of return on equity is profitability, as indicated by the profit margin. By increasing its profit margin, Minico would increase its return on equity as well.